Good afternoon, everyone, and a very warm welcome to the latest Institute of Financial Accountants National Branch meeting. I hope everybody's keeping well, and I hope your day and your week has started successfully. Thank you for joining us, and look forward to the next hour with us. Can I, as ever, just start off with some housekeeping? I hope we don't have any technical issues, but if we do, please bear with us. We will look to resolve those as quickly and as efficiently as possible. If you are, though, having sound or visual issues, can I just ask you check your own setup, your own system, your own Wi-Fi. We found that in the past, it's actually been with individuals' equipment rather than the Institute's Zoom webinar platform. But please, if we do have technical issues, bear with us. These sessions come to life because of the questions, the observations that are made. There is a Q&A box either at the top or the bottom of your screen, however your screen is configured, as well as a chat box. Please use that to ask questions. I will interrupt our speakers if I feel it's pertinent, if it's relevant, or I will just leave all questions till the end. But as I say, these sessions come to life when we do get questions, observations, and comments. And for everybody's information, today's webinar will be recorded. Can I welcome back today's guest speakers, David Oliver and Dave Rfqs. David and Dave spoke, I think it was at one of our June National Branch meetings. And at the end of their session, I must have had a dozen members posting comments in the chat box facility asking, great session, can we please have both gentlemen back to do a follow-up and a further session? We've listened, and David and Dave, welcome back, and thank you for joining us this afternoon. David Oliver. David is the founder of Insight Marketing. He's a keynote speaker, thought leader, and an author of no less than 14 books. David has worked with, as it says on the screen, thousands of accountants around the world, whether that be in the UK, America, or Australia. David shares practical insights that help accountants and their clients make their business life better, more profitable, and more enjoyable. Dave Rfqs is the founding director of both BCMS and Kingsbrook. Kingsbrook UK is a market leader in the sale of SME private companies. I also just looked at LinkedIn a little earlier on, and recommendations, referrals are always a good thing, aren't they? Dave, one of the referrals you have, I think, sums it up, to be honest with you. Dave is the UK's leading authority on acquisition and mergers. He is simply the font of all knowledge on this subject. So, David.
Sorry, Richard, Jonathan, I don't recognise that introduction, but I can't wait to hear myself speak.
Well, I try to be polite, and I try to make sure that our guests and our speakers are given the introduction they deserve, Dave and David. So, look, today's session is all about how you help your SME clients prepare for and then execute a succession plan or an eventual exit. Enough from me. Gentlemen, I will stop sharing. David, Dave, I'll hand over to you. Thank you very much indeed, and welcome both again.
Thanks, Jonathan. It's always a joy to be with IFA folks, and you've really bigged David Rfqs up, Jonathan. So I hope what he says is useful and makes sense. We shall see. And we've been introduced, obviously. Thank you, Jonathan. David and I have also, by the way, in addition to what Jonathan has shared, worked together with an accountancy partnering program, helping firms who want to be able to offer an exit solution or a succession planning input for their clients. And the IFA and its members, through Jonathan's hard work, have been part of this partnering program now for 4 years. a very quick introduction before we get into practical stuff with takeaway templates and ideas that you can use. BCMS Corporate and Kingsbrook are part of the BCMS family of businesses selling accountants' clients. And over the last 32 years, the Kingsbrook and BCMS group have sold around 1,500 companies. And it's from that experience and our work with accountants along the way that we're going to share together today. Now, the clients at Kingsbrook are really just like your clients, pretty much a 50-50 split between product-based companies and service-based companies. 90% of them are privately owned, owner-managed businesses, again, just like your clients. Revenues do vary dramatically. They vary from below $1 million in sales or turnover to well over 20 million in sales or turnover. During the webinar today, we're going to mention a small PDF book that is available for you to give free to your clients. We'll talk about it a little bit more, just to give you the early heads up. If you'd like a free copy of this book, as we always do, just pop your email into the chat function now and just say free book, please. That covers all the GDPR concerns for the IFA and enables us to get you that book. Now, I want to kick off today, and this won't surprise those of you who've heard me talk before, with trusted advisor status. It's in the context of helping IFA members with what I call BAS. As long as I've known Jonathan, and in our work together with the IFA, whenever Jonathan and I have had a beer or a coffee, he's suggested that we could do something together to help IFA members move to what we call BAS. It's very simple. It stands for Business Advisory Services. It's a descriptive term, but it's broad enough. And I hope that, as is the case when I talk to accountants, when we discuss business advisory services, by and large, people's eyes light up and the animation is usually present. But the big question, the big challenge is, particularly if you're a small firm, even more so if you're a sole trader, how do we do this? And between us, David and I are going to give you practical help, takeaway help, template help. But let me start first with the why. There are several reasons why business advisory services are important. And again, you'll have heard me talk about this at most of my events. It has to do with you truly believing that you are, in fact, authentically the most trusted advisor in your client's working life, and often beyond. The truth is, unless your client has a faith-based pastor or a life coach, your input is probably the only input in their life of its kind. And that has huge privileges. And I want to suggest today, it also carries with it substantial responsibilities. This trusted advisor status has become even more important in the past few years as your clients have faced Brexit, then COVID, along with some seismic shifts in bookkeeping and compliance work. And I watched this in my own experience. When David and I were preparing for today, I thought back just this year, if my accountant suggests a pension contribution in this financial year, I'll move maybe tens of thousands of pounds on that advice. In fact, I did. If he tells me to consider a car purchase or lease this way or that, I'll most likely do it. If he tells me he's found a good financial advisor I should chat to, I will make the appointment. And even on the most mundane of things, if he says, look, we're using a great office printer, which I think would be fantastic for your small office, I'll take a look. Now, you probably don't even think much beyond the comments that I've just made, but the reality is that is huge trust. I don't give anybody else in my life that kind of access to my thinking, my decisions, my money, and my purchases. And if we contemplate on this in the cold light of day, think about it objectively, I think we have to say it is truly remarkable. And the second reason, and this is why Jonathan has asked me several times to talk about this, why this has become increasingly important, is that in the past 5 years, the change in our profession whilst it's been talked about a lot, I'm not certain it's fully embraced or fully understood, or that accountants have fully woken up to the seismic change that presents responsibilities and opportunities for us to grasp. Now, let me summarize the elements of that change. They won't be new to you, but understanding the implications may be, and doing something about it is quite likely going to be new. But the obvious things, for example, cloud accounting, making tax digital, online VAT, they've changed things for you, yes, but they've also changed things for many of your clients. The advent of cloud software with the inclusion of receipt manager, bank feeds, and the like means within minutes every day, as a client, I can view my money in, my money out, my current balance, outstanding debtors, other critical business management tools. And as a by the way, incidentally, and I'm sure Jonathan and the team will have talked to you about this, do make sure you have access rights. They are critical. If clients sign up through your software account as their accountant, recommended by the way, you automatically have access rights. But do remember, if they buy somebody else's software or have purchased it themselves, you are going to need to get those access rights. Access rights give you the advisor status so that only you can make the journal adjustments. Now, of course, and again, I'm not teaching you anything new yet, the following things are automated, aren't they? Already: statutory accounts, management accounts, tax return, VAT return, payroll, dividend vouchers, auto enrollment, and the like. Now, the implications of that is what I want to touch on briefly. If you look at the slide on the screen, we can see the present and the near future as described by two respected commentators. By the way, if you've not read either of these two books, and if you read few rather than many books, can I recommend you start with Remaining Relevant and have a good read of that this year. And then if you can, move into the future of the professions. The quote at the top is sobering, and it's obvious, isn't it? No one could stop huge technology companies from heavily promoting their solutions to your clients' businesses, but it's time to embrace this change and to face the reality that compliance will become increasingly commoditized. Cloud accounting will be installed, they reckon, in over 90% of small to medium-sized businesses. Practice management in the cloud will be in 90% of accounting firms. What that means in reality is clients will be more transient, and the likely pressure on compliance prices is going to be high. The proposed reduction, or the predicted reduction, sorry, is a better word, 20 to 50%. So it could sound the death knell of time-based billing as the only model. I don't believe time-based billing will go altogether, but it's also, whilst it sounds the death knell, it creates the new life of business advisory services as a possibility. And again, the prediction in these two books is that business advisory services will ultimately grow to 80% of accounting revenues. The big deal, however, is that finally the clients get what they really want from the trusted advisor who's already there in their lives. Now, number crunching or compliance work has to be there. Of course it's there, and it's valuable work. But can I articulate it this way without demeaning it? It's no longer in the driving seat. Up to about 5 years ago, compliance work was what drove the relationship. I want to suggest to you it's firmly in the backseat. It's still in the car, but it's no longer in the driving seat. And you've seen it, folks. You must have seen it with cloud services like QuickBooks, Xero, Sage, actively promoting to small businesses, tiny micro businesses on UK TV. Then as accountants, we have to be more, we must have more, and we therefore should offer more. So what exactly can that look like? What is this new role for the IFA member, if you like, as trusted advisor? I want to say it as clearly as I can, at the risk of repeating myself. The new role the new future, the new normal has to be moving increasingly to business advisory. Now, what that means in practice is a number of things. But for example, instead of 1 or 2 conversations every year with each client, which is always looking backwards, by the way, checking expense claims, looking at journal entries, looking at the P&L, wise IFA members will now be having conversations with their clients over the full 12-month period. And instead of looking backwards, and we'll give you some keys today, you'll be looking forward. That's the nature of advisory. And I want to suggest, if I may, that this shift in presence, as I call it, being there, being present, is going to shift IFA members' work from compliance focus only and traditional bookkeeping to a genuine, relationally managed business input, finding out what your clients really do need, what they really do want, and then providing services that leverage your trusted advisor status beyond the number crunching into the realm of valuable business advisory services. So putting it another way, the available automation should not really be a threat. It should be freedom for you. It should leave you more time. And it means if you choose to, you can take this unique moment in our accountancy world's history and begin to offer a whole range of business advisory services. Now, today, because we're focusing on exit, I'll just mention superficially in passing. On the left-hand side of your slide, you can see what's automated already, and we've talked about that. But for example, business advisory services can include mentoring clients. Most of them are desperate to be mentored, helping them with SWOT analysis, strength, weakness, opportunity, threat. Have a template which you can offer them for a conversation. Marketing and growth programs, I'll talk about that briefly today. Tax efficiency and planning, helping them with key performance indicators, using balanced scorecards. And then today we're going to help you, between us, Dave and myself, legacy and succession planning and exit planning. So just to summarize my introduction here, as IFA members, with the backdrop of the IFA brand as well, you are truly the most trusted advisor to your SME clients. Doubly important, I submit to you, when it comes to succession planning and eventual exit. No one else in your client's life, please hear this, no one else in your client's life will speak with the authority and the trust that you as their accountant already have. So that leaves you, as I've said once already this morning, with both a privilege and a responsibility. Now, this webinar will give you some practical knowledge, some templates and tools that will help you exercise that responsibility authentically, practically, and helpfully. Now, it's commonly the case, by the way, that with any business advisory service, by and large, the accountant can't or won't do it on his or her own. It always or nearly always requires working with trusted partners. And with 10 years now working with an accountancy partnering program, we're able to support you as IFA members if you have any client who is looking at exit or who's looking at succession planning, and today's remaining content is going to unpack that. I'll hand over to Dave in just a moment. Just before I do, worth mentioning at the beginning, and I will do again at the end, there are substantial advisory payaways for IFA members who work with the BCMS Kingsbrook program with any clients who are suitable for exit. And for details of that partnering program, just again, pop your email in the chat box and say partnering program details, please. Dave, you're going to take us through preparation for a sale.
Yeah, thank you, Dave. Well, as Dave suggested, with over 1,500 deals under our belt, the link between a successful sale and good preparation is dramatically evident. And I think it's fair to say that many, if not most, or for most people, the sale of their company is amongst the most important deals in their lives. And yet so often that sale is left to chance. And this can all too often be a bit of a trait of an entrepreneur. Unfortunately, they can be full of action with little patience for the detail. And I know there that I'm generalizing horribly, of course, but little is often done to ensure that the right buyer is found, and little is done to ensure that the deal does not fall over. And the actual result of all of this is that only 8%, 0.8% of owners manage to successfully sell their companies. However, more than 80% of those owners are heavily reliant upon the successful sale. It, in effect, is their future. Now, the primary driver to ensuring that a sale goes through at a good price is to have a competing choice of buyers. That's by far the number one consideration. But the second consideration is to do with preparation. And lack of momentum always kills deals, and discovering issues too late is a primary cause for deals not going through. And almost every issue can be dealt with, but if it's left too late, it will always take too long, and the buyer will lose trust, and inevitably it seems that they walk away. Let me give you a bit of a golden rule in our industry when selling a company. When selling a business, there is no such thing whatsoever as a good surprise. Every surprise you get when selling a business will always be a bad one, I guarantee it. And I can't stress how important this is. The longer a negotiation protracts and drags on, the disproportionately more likely it is to fall over. However, the faster a deal progresses, the more likely it is to complete. There's a very direct and linear relationship between momentum and success. And too many advisors naively overlook this issue, and it shows in their very, very poor success rates. So being ready impacts these things, and legal pre-due diligence and preparation is not expensive, but it will produce huge value, particularly value in three areas. First of all, it will improve the value of the business financially, the financial value. Number two, it will dramatically improve the likelihood or the chance of selling. And finally, it will noticeably speed up the deal, reducing the shredding of nerves that may well take place without it. Now, there are typically 8, or particularly 8 common deal killers, which are the following, and I'd like to just touch on them fairly quickly, if I may. These are the things that we find trip deals over on a regular basis. Number one, funding. And although this cannot be addressed very early, it must be considered as soon as you've identified a buyer. Many, many deals fall over because either the vendor or their advisors naively believed the buyer when the buyer assured them that they had the funds. And all too often, the seller discovers the truth too late. Finance was not secure, and the deal now stumbles. And if your buyer has to borrow heavily to buy a business, then it's likely that you'll have a major, major problem. Most of our deals at Kingsbrook involve little or no borrowing whatsoever. Number two, share buybacks. Of course, there are numerous ways that a company can return wealth to its shareholders, and the most common is via dividends, but another way is share buybacks. And as you know, this is where the company buys back its shares from the shareholders with its own accumulated cash. And a share buyback is a way for a company to almost reinvest in itself. However, it's all too frequent that the process was not correctly administered. And all too often, the old shareholdings were not cancelled properly. And the old shareholder remains inadvertently an owner. And if that shareholder is no longer involved with the business, they now have to be located and motivated to cooperate in the sale. And this can be at times thoroughly complicated, as you can probably imagine. Number three, EBTs, employee benefit trusts. Now, if there has not been an early settlement with HMRC, then this will usually lead to a delay of up to 12 months and almost always the loss of the buyer. This length of delay is far too much for most buyers. Number 4, minority shareholders. Now, I slightly touched on this in point 2, but when setting up a company, perhaps many years ago for most, no consideration was given to a sale. This is common, and the result is that there were no drag and tag along provisions for minor shareholders. And at the point of sale, you suddenly discover that these minor shareholders have both the power and the ability to create problems for the sale. Now, if this is discovered early, it can be easy to amend the Articles of Association, but you don't want to discover this too late. On one occasion, I remember we discovered a minor shareholder that was employed many, many years ago. And this was identified at the closing meeting, the legal closing meeting. And we had to track down that old owner and get somebody to travel by train into London to meet that person at his home and get him to sign off on the deal. Can you imagine the stress for the seller? Well, fortunately, the shareholder was not in a mood to cause trouble. However, often these shareholder departures are the result of a bit of a bust-up between shareholders. And if the issue is not dealt with properly, then a bigger problem awaits downstream, as I'm sure you can imagine. Number 5, statutory books. Now, many company owners do not know what these are and why they're important. Proof of shares, as we know, is not via the confirmation statement or the annual return, which is filed at Companies House. Rather, the title of shares is proven by the share certificate and statutory books, which show the history of share transactions. And every buyer is interested to check these documents. It always comes up in a sale. It's easy to resolve and problematic if not dealt with early. If discovered late, then it can take a long time to reconstruct the statutory books and lead to some quite serious delays. And again, these delays often prove fatal to deal completion. Nothing kills a deal as often as unnecessary delays, as you're probably getting that impression from what we're saying here. Next, contracts with clients and suppliers. Do these contracts have change of control clauses? This can be very simple to correct, but if left unaddressed, it may lead to the buyer having to fully cancel any contracts and reinstate them. And many buyers will be nervous about this, and they'll demand that much of the sale price is withheld until clients have agreed to those new contracts. And all of a sudden, the payment for shares is delayed and out of the control of the owner, the current owner. Is very bad news indeed, of course. Next, number 7, net asset targets. How is stock valued, and will the buyer see it in the same way? This is a common reason for conflict between buyer and seller, and it needs early consideration. Applying the right principles ahead of the exit is an important and often overlooked matter. The associated problem with this that goes on with this is understanding surplus cash. How much of the company's cash is working capital and how much is genuinely surplus? Most sellers are a little bit naive in this area and expect that virtually all the company's cash is considered surplus. And this can lead to a lot of tension between buyer and seller. So some seller expectations must be managed early in this regard. Some education on this matter will most likely be needed with your clients. And finally, loans, company loans to directors, director loans to the company, or intra-group or intra-company loans. A buyer will expect these loans to be paid upon completion. This means that both buyer and seller will need to have clarity and transparency in this area if the buyer and the seller are not in agreement or on the same page. If not, then expect conflict and trouble with the buyer. And again, an early assessment of this matter is quite vital. Well, for us, these are the 8 things that usually present themselves as problematic in a sale. There are other issues, of course, but 90% of the problems, it seems, come from one or more of these 8. Now, again, I risk losing you through repetition, but an early and honest assessment of these 8 things may well be the difference between a deal and no deal at all. And at best, you can expect a protracted deal and all of its associated stress. Now, the flip side, of course, is that if a seller does address these matters, then there is no reason why a deal cannot be straightforward. And in addition, if you have a choice of buyers, then you control the negotiation, and good preparation and negotiation control through choice reduces the stress of the deal quite dramatically. So, in summary, legal preparation is easy, yet it's usually overlooked. It's a primary reason why so many shareholders never manage to sell their business. No preparation nearly always leads to a bad surprise and to deal failure for two reasons. Number one, it's too late, and dealing with the issue will just take too long. The buyer's concerns become so high that they eventually pull out entirely. And secondly, the best outcome is now that a deal with a major price drop. And usually, it can often be the case. Usually it's no deal at all, a deal collapse, but at best, a major price drop. Now, somebody will carry out these tests, and it's important that the owners don't abdicate responsibility. If it's not the current owners, then it will be the buyer. And by then, it's usually far too late. Dave.
That's fantastic, folks. Those 8 points of failure, could you see that as a business advisory conversation you could have? And then maybe get engaged as you take your clients through those 8 steps, helping you identify on that journey at what stage that particular client might be towards exit or succession planning. Now, we've also got to help our clients grow their business to sell, because if you listen to our last webinar and looking at the names, a number of you look very familiar. So you'll remember probably we majored heavily, did a whole session on selling the future. By the way, if you missed that last event, I'm sure Linda would be able to send you a recording or a copy of the slides. Now, during that session, we suggested that future potential, of course, is the essential ingredient in the acquirer's appetite to buy. And we know from data that 66% of all buyer motives for acquisition are said to be totally related to future value. Now, think about this sentence with me for a moment. Nobody ever buys a company's history. Now, think about that. You might find yourself reacting. You might be thinking, no, hang on, David, that's just naive. Our company's got a huge brand name, global reach, a reputation for quality, for IPR, for unique systems or processes. Well, folks, they may well have all those good things, but there's not a buyer in the world that's remotely interested in the difference those good things made to your client. The only interest a buyer will have is the difference those good things will make to his or her future. So that's why we must sell the future. So far, so obvious. Now, it's interesting that acquisition directors of large corporate acquirers live by a set of guidelines. They're called the 8 acquisition musts. And interestingly, 5 out of these acquisition musts are all about future potential. And not one of the 8, by the way, talks about return on investment. But just to illustrate, let me give you acquisition must. And number 1, it says this: try to pay for a company's past. They'll want to do that. They'll want to convince you and your client that that's the real reason that they're buying or offering. And then consider its present, but only ever actually buy that company's future. And it comes with a bit of running commentary, but in essence, what they're saying is this: when you're a buyer, try to get the current owner and his accountant to believe that it's all about past performance. They'll want you to think that. And by the way, if you were the buyer, you would too, wouldn't you? Consider the company's present position fine, but only ever actually acquire the company's future. And those acquisition musts, 8 of them, 5 are all about future value. Now, as a result of all that, we actively work and encourage our partnering accountants to work with clients to fully consider the areas of growth within their current business. So we'll recommend to an accountant, look, get your clients to start thinking about a growth plan. What would they do with the business if time, money, energy, and resource were no obstacles? Now, you might find you get a bit of a fight here because some business owners are too tired or got no inclination to invest in growth. But you've got to get them to think, well, hang on, if you did have that inclination or appetite, what would you do? And the reason why this is important is that the answer to this question is going to help us together find the upsides, the future value for the right potential buyer. It's going to help us make a strong case for what the new owner can do if they add all their resources, clients, and sales activity in order for them to get a bigger, better, different future. That way, then, it's crystal clear, isn't it, to the buyer where the growth can come from. Now, you're probably ahead of me already, but the potential challenge to what I'm saying is this. What if there's no demonstrable evidence about how that growth could be achieved? You know, is it just wishful thinking, negotiations speak? And it's here that we encourage accountants help their clients to have an evidence trail. I call this the maths of selling. Now, I've been teaching this for nearly 4 decades. I've invested this into thousands of companies, and it always works. As I introduce it, there's a really helpful illustration that you can find in the farming community. The average farmer is going to make legitimate assumptions about climate and fertilizer. In fact, if any of you have been watching Jeremy Clarkson's farm, you'll have seen this formula. Bizarrely, he used it himself, but you've got to make legitimate assumptions about climate and fertilizer, but the objective is 4 to 5 tons of winter wheat. In order to achieve that, you have to sow 70 kgs of seed by a given date some months earlier. Now, of course, the conversion ratios may change a bit, greenhouse effect, too much rain, too little, but the fundamental principle that undergirds it all is unless the farmer sows the right quantity, he can never reap the right quantity. And it's just the same for our clients. Our clients' various sales and marketing initiatives or channels are a bit like the farmer's sowing process. The client's monthly results or annual results, that's the harvest, if you like. And unless there is disease or drought, the farmer knows that he will always reap what he sows. And interestingly, by the way, he will always reap in direct proportion to how much he sows. And in sales, we fulfill the ancient proverb, which simply states, what you sow, you reap. Now, if we're going to have an evidence trail, we have to address this in a template form, a formulaic form. What I'm going to leave you with today, and it'll be on the slide and you're free to use it, by the way, it's our gift to you. It's a formula that, as I've said, has been tested in thousands of companies, and you can tailor this formula to each of your clients' sales and marketing approaches, online or offline. Now, in our farming analogy, you probably spotted it, but the farmer works on the basis of just 4 very simple critical assumptions: soil, seed, fertilizer, climate. Once he has those documented, he can base his maths reliably on the facts that he knows. And it's helpful. Some find it liberating to know that for any of your clients' business growth, the same thing is possible and the same process is also necessary. There are 4 basic questions that need to be asked and the answers obtained in order that a realistic business growth target can be set for future sales, whether that's telemarketing, appointment generation, sales presentations, online advertising, Facebook or Google, website visits and conversions, or any other dimension of selling that may be in your client's plan. Now, time is limited, so I just got to pick one example. The formula works for any example, any sales channel, any approach. but I'm going to illustrate today from a telemarketing application. So let's assume that your client is going to use telemarketing as part of his or her business growth. We're using this right now to help you prepare a client for exit, but you can offer this as a business advisory service in its own right. Let's take a look at the 4 questions. They're not rocket science. How much new business is your client hoping to achieve per month? If it's an annual target, divide it by 12. What is the average order or job value for your client? If they got 1 or 2 really big jobs, 1 or 2 really small ones, do a sense check and do an intelligent average. What is the conversion ratio of inquiries to orders or RFQs to orders? RFQ is just a request for a quote. So what's the conversion ratio in your client's firm? If they get an inquiry, how many inquiries do they need before they get 1 order? And then 4th question, how many calls, remember this is telemarketing, how many calls or leads followed up does it take to produce 1 RFQ or 1 inquiry? Dave, we'll skip to the 2nd formula slide, please, if you wouldn't mind, just for the sake of time. Move on to the next one, if you would, Dave. Thank you very much. So here's the formula unpacked in reality. So the previous slide you can use as a template. It'll be on the recording, just copy it. And I've now populated the slide so we can get straight to the heart of our exercise. Let's say your client wants 120 grand a year new business, and so that equates to 10 grand a month. The average order value over the last 12 months has been 2,500. The number of new orders required per month, even I can do that math, A divided by B, they need 4 orders per month. What's their average conversion ratio of orders to inquiries or orders to requests for quote? 1 in 4, by the way, is a global average. It's a norm. If it's 1 in 5, it's okay. If it's 1 in 6 up to 1 in 10, something is desperately wrong. If it's 1 in 2 or 3, don't let them get cocky. It probably means they're underpriced. But 1 in 4 is a pretty good average if it's new clients. If it's existing clients, it should be much better than that. New clients, 1 in 4, 1 in 5 is a reasonable global average, regardless of sector or size. It's amazing. One of those little nuggets of mathematical and evidential truth. So the number of new telemarketing calls to produce 1 inquiry is the next fact we need to know. And 40, it could be 20, it could be even as bad as 100. It varies, again, dependent on the individual and the sector. So the number of new telemarketing calls per month required in this model is 640. Now, couple of really important points to make. If you introduce this to a client, and remember you can adapt it to online, to pay-per-click, website visits and conversions, just simply adapt it. Don't take the first few months as gospel. By and large, after about 6 months, the actual results you're getting, this is our best guess to start with, the actual results as you measure them, after about 6 months are pretty reliable. After a year, bomb-proof, rock solid. You can build a great business growth model. Now, the reality is, as we've suggested, this data is going to help us find the upsides for the buyer later on. It helps us make a strong case for why the buyer should be paying for the future, not just because we say so, but because we can show so. And it shows them what they can do with all their resources and their sales activity added. And it's got to be crystal clear, therefore, to the buyer where that growth can come from. Here's our evidence trail. And by the way, if the buyer can't do considerably more to grow the business than we're evidencing, then we've probably got the wrong buyer. They should take this evidence trail, and then with their greater resources, greater access to finance their own clients, maybe geographical locations, more salespeople, they can leverage that growth. But in order for us to leverage this future growth in our negotiations with different potential buyers, we have to have the evidence trail for business growth. So talking of negotiation, David's now going to take us through the negotiation process during your client's exit. Dave.
Thank you, Dave. Well, there's much we could discuss to do with negotiating the best price, but I'd like to focus on 4 short things that we know to be vital at the closing stages of the deal. And those are this. Number 1, let me change slide. Don't chase enthusiasm. You know, we typically identify 80 to 120 potential buyers. And after heavy qualification, we get that number of buyers down to 5 or 6 bidders on average, and some of them can be very, very enthusiastic for a deal. But I don't know what you make of this, but we think that enthusiasm is one of the worst things you can look for in a purchaser. It's meaningless. It's neither good news nor bad news. It's completely irrelevant. It's neither positive nor is it negative. It's irrelevant. And there's a bit of a sinister issue with that. It can be rather seductive. We tend to run after enthusiasm. It's a nice characteristic. It's an attractive characteristic, but it's a bad qualification. And most corporate acquirers can come across as very enthusiastic for a deal, and that can entrap a seller. And they can be caught up with that enthusiasm. They can latch on to the buyer at the expense of talking to other potential buyers because they've been drawn to that enthusiasm. And a few months down the later, the buyer has got you on your own, has got the seller alone, and you'd be shocked in the change in the nature of the purchaser. You used to get on so well with that buyer, but now it's becoming so difficult. We don't like this about your business. They start to say, here's another problem here and another issue here, and the price gets ground away. It's got nothing to do with their initial enthusiasm. Don't get me wrong, it's a great human characteristic. It's just a really, really bad qualification and measure when you're negotiating a deal. Secondly, can they invest? We're looking for their ability to invest. Can they afford this business? And that's an important one. I've already touched on this to some degree, but are they able to find, and do they have access to the funds? And there are occasions, about 18% of cases, where when we first approached the buyer, they didn't appear to have those funds, but went on to have good access. So you need to be a little bit cautious about this, but are they able to invest in this business? If not, then it is really, really important that we disqualify them early and do not progress matters. Number 3, complementary in nature. How do the seller's customers fit with the buyer's customers? And the best fit, and therefore the best negotiation, tends to be when the fit is complementary. The buyer and seller offer different products. They don't compete with each other, but they fit alongside each other. And this is when the value of a deal starts to mushroom. The buyer can open up their clients to the seller's products and services, and vice versa. And they fit alongside each other. And this mushrooming that benefits both companies will aid greatly in the deal negotiation that we're going to be entering. And finally, and fourthly, choice. Choice is king when selling a company. We've hinted at this already, but having a choice of buyers is the number 1 issue. Nothing compares to the importance of this. For example, Dave talked about how important it is to sell the future. Well, the reality is you can't do that unless you've got choice. If you sell the future, then you're asking the buyer to pay a premium price over and above traditional multiples of earnings. And if I was a buyer, I'd have to say, why should I pay that premium price? On what basis? It's unreasonable to ask me to do that, but not if we have choice. Then it suddenly becomes quite reasonable. Choice is so very important. If we genuinely have choice, then and it's on our side, it is very appropriate for us to say, look, if this future opportunity that we can so demonstrate has no value to you, then simply reflect that fact in the bid that you're about to make. But we know that future potential genuinely has value to most buyers. Maybe occasionally not to some, but to most it does. And if you happen to be a buyer to whom this future potential doesn't have choice, then reflect that in the bid that you're about to make. But in the face of competition, it is really appropriate that to be able to sell the future. And as Dave said, don't forget 5 out of 8 acquisition musts are all about the future. It really has value, but it is only brought out by having a choice of buyers. And choice affects 3 things. It affects, number 1, the speed of the deal. We've already talked about how important this is, and most people dramatically underestimate the importance of momentum. And we've already said the faster a deal progresses at this late stage, the disproportionately more likely it is to complete. The more a deal protracts and drags on at this late stage, the disproportionately more likely it is to fall over. Number 2, it affects the price. It will always impact price in any negotiation. We've been through a bidding process, and competition gives the buyer permission to pay a premium price. Not only that, it helps sustain the price. The buyer has agreed a certain price. Maintaining competition means that that price is maintained. It doesn't get beaten down through ruthless negotiation. And finally, the terms of the deal. It impacts those terms considerably, that you sell not just for the price that's right, but for the terms that are right, that you sell for cash rather than shares in the business. Beats me why anybody would ever want to sell for shares in the buying company. I can't remember the last time we ever did such a thing. But if you have a choice of buyers, you control the negotiation. One of the less obvious or less apparent things about choice is that it enables first offer rejection. And I'd like to finish this section with a story. If you'll allow me, one of our clients, they specialized in traveling around the country collecting sawdust from timber mills and companies that made wooden products. They would grade this sawdust and sell it for 3 applications. Pets bedding was number 1, equestrian flooring number 2, and burning in salmon and other meat smokeries was number 3. They were a family firm and they were facing bankruptcy. And their plea to us was, would you sell us at any cost? Just lift this burden off of us. Well, we identified 276 potential buyers. And out of that 276, we only managed to get 2 bidders. We nearly didn't get choice. And the first offer came in at £200,000. Our client was overjoyed and said, look, take it. We'll take that offer. We'll accept it just to lift this burden off of us. And the second and only other offer that we got was from a company called R. Plevin & Sons, who put in an offer of 3.5 million. And our client said, take it, we'll accept it. As you can imagine, they would. And we said to our client, we think that you should allow us to reject Plevin's offer. Now that takes a bit of nerve. To be honest, I don't know whether I'd have the nerve to reject such an offer. Maybe if I had a 3 million to fall back on, perhaps I would. But 200,000 was our fallback. And to the credit of our client, they allowed us to reject Plevin's offer. Plevin's eventually paid 4.2 million cash all up front. Why? Choice, competition. Competition was the driver in it, as it so often is. And it is so very, very important that we ensure we have competitive environment in the negotiation of a deal. Dave.
Thank you so much. Now, in 2 minutes, we're going to hand back to Jonathan and Linda, see if there are any questions, but a couple of points as I conclude our contribution. The great news is with business advisory services, if your client does exit, you don't lose a client, you gain far more services. And 3 obvious areas, most of them will move into some kind of philanthropic endeavor. They'll want help. All of them will want tax advice, tax planning, pension advice, pension planning, and 50% at least, it might surprise you, will want to start up again. They now control the time, they've got no finance worries, they're pretty keen to give it a go. And then importantly, as IFA members, you can access a range of free support services from Kingsbrook that will simply help you in the business advisory role. We've given you some templates, some ideas and thoughts to follow today. There are generous payaways, which I'll come to finally in just a moment, and there's a free saleability evaluation for you and your client. What does that actually look like? Well, if you've got any potentially interested SME clients, typically in the turnover or sales range of £250,000 sales to 10 million sales, you can arrange for a totally free 1-hour business evaluation session where the potential saleability of your client's business can be explored transparently with you, or if you prefer it, directly with your client. Of course, it's totally free. What it does mean is if the client's business is not saleable at the moment, in our opinion, we can recommend some things that you as accountant can do with them as business advisory service that will help them get ready and get saleable. If you'd like details of all that, just type details, please, in the chat box. And again, provide your email address for GDPR compliance. The payaway, by the way, is a 5% payaway from the upfront consulting fees and a 5% share of the ultimate success fee. And most accountants typically will earn between 3 and 10 grand for a successful transaction of that kind. Jonathan, I'm about to hand over to you, but if at any time you need advice on a particular client who is or who should be contemplating exit, you can email me direct or even call me, and Jonathan or Linda will pass you those details. And remember, if you want that PDF book and you didn't request it, I saw quite a few have, go ahead and request the book with your email in the chat function. Jonathan and Linda, thank you so much. Over to you both.
Thank you, David. Thank you, Dave. Incredibly insightful and some really, really practical and helpful thoughts there. So it's much appreciated. Can I just ask, please, if you want a copy of the book that David has referred to, can you please just put your email address in the chat box? We will pick that up and provide those details to David and Dave. I see a number of you are doing so already. I'm aware that David has to be off for another appointment exactly at 1 o'clock. So if there are any specific questions, can you please sort of post those now and we can cover them off? David, there was one right at the beginning. You talked about remaining relevant. Sorry, who's the author of that book, by the way?
Do you know what? Without the slide, I can't remember.
Right. The question was asked and then I couldn't see it I couldn't make it out. Maybe that's my eyesight failing me.
Jonathan, but it should be clear. Bob Nixon it is.
Bob Nixon, thank you very much indeed. Gents, you also talked about, or Dave talked about the 8 reasons for failure. And if we've got members who are wanting to enhance that relationship with their clients, take that step, towards the business advisory service, 8 reasons for failure, Dave, quite a number. From your experience, are there 4 that are more prevalent than the other 4? So, should members focus in upon certain areas rather than focusing in on all 8 at the very beginning?
That's a good question. Funding is a very common one. EBTs are a regular issue, but not that many of our clients have EBTs now. So if there is an EBT, it definitely must be looked at. Statutory books, net asset targets, I would probably put those down first, but it's not that difficult to look at all 8, to be honest. So I think if I was going to go and see a client, it would be really relatively straightforward to look at all 8. And by the way, if you want a lawyer to work with you and your client at looking at some of these things, then there's a very, very good client that we work with regularly, independent of Kingsbrook. And if you want her details, we can gladly get some contact information to you. So let us know. And she is just so good at looking at these 8 things and has helped us devise a program for sorting these things out.
Okay, well, a question, sort of maybe a final question from me, because I'm conscious for David's time. Are we able to share the slides, gentlemen, with the attendees in the next 24 hours?
Yes.
And then, David, what I was also going to suggest was, well, we can provide your contact details on there. We will provide you with the email addresses separately for those attendees who want a copy of the book and maybe a further conversation discussion with you.
No problem. We will get the slides. I'll get the slides to you by end of play today. No trouble.
That's
I have
great.
to leave now. Forgive me. I've got a hospital appointment, and with the current state
No,
of
David,
hospitals, I can't miss it.
thank you for your time.
Care, Dave.
Thanks, David. Thank you to David. Thank you to Dave as well. If there are any further questions, please just post them. I'm just going to sort of remind members, if I can, there are a range of other CPD webinars coming up in, well, tomorrow. So at the very back end of September and throughout October. So please, if you've not looked at the Institute website and you're not aware as to the national branch meetings or the tax series, or there is a Companies House webinar that we've been promoting tomorrow, the accounting treatment, financial reporting webinars that we have put on and continue to put on, please do take a look at the website, CPD tab underneath the webinar section. All of the detail can be found there. Can I also, a couple of reminders for members, the digital hub, www.financialaccountant.co.uk. I was contacted over the summer by a number of members when we weren't running the national branch meetings, asking for information, or did we have content and information on particular topics and subject matters. For a number of those, I knew that we had content and articles on the digital platform. If you are ever wondering, if you're looking for content, information, help and support, please do go to www.financialaccountant.co.uk. Another sort of update or reminder, members will be receiving, I think it's this afternoon, all members will receive a pre-renewal email from us, just talking you through, reminding you of the process that we find ourselves entering into, as always, from October onwards. Please look out for that email and those subsequent emails and respond accordingly. If you have any queries or questions, of course, please do make contact with us and the membership team as soon as possible. Another reminder of members' CPD requirements for the year. I was asked this just last week at a local branch surgery. It is 40 hours. 20 of those hours need to be verifiable, 20 are non-verifiable. And the last reminder or update from my side was just to remind all, we are running an online international conference on the 25th of November. That is an all-day event. It's being run online using the Zoom webinar platform. We are covering 5 topics that are relevant to accountants, members, non-members, finance professionals, whether you're based in the UK, the Middle East, Africa, or Southeast Asia as examples. Those topics: sustainability, funding, technology, governance, and integrated reporting. If you've not looked at the conference details, please do so. It's got its separate page underneath the CPD heading. I would say this, but I believe we've got a fantastic speaker lineup. But the conference is being headlined from a speaker perspective by the CEO of IFAC, the International Federation of Accountants. That's a very good coup by the Institute. Please do check that out. Please do look and follow accordingly. Dave, can I thank you once again for your time this afternoon? Just like the first session, really helpful, really thought-provoking, and very helpful. So thank you for joining us. It's much appreciated. David, I thank you before he left us. Thank you to the members who've provided their email addresses. We will provide that to Dave and David, as I've said before, and we will make sure that they send that book and information to you. We will share the slides with you within the next 24 hours. Dave, I've seen a number of attendees comment to say thank you for the presentation and the fact that it's been extremely useful. To everybody, have a good afternoon, and we look forward to seeing you again in the near future. Dave, David, thank you to all. Have a good afternoon and cheerio for now. Bye-bye.
Thank you.